Hello! A lot of investors do not know how to value a stock properly and when it makes sense to buy it. Even more investors is struggling with when to sell a stock because the upside of the stock is limited. In this video, I would like to go through my buy and sell strategy, and I will be demonstrating it on my recent buys and sells. I'll be using MoatIQ, which is a tool for valuation and moat analysis. So let's dive in. One of the beaten down stock today is ServiceNow. This company is on my watchlist for some time. I'll be using a discounted cash flow model to estimate its fair value. With the discounted cash flow model, we project the cash flow the company will generate in the next years. And then we discount those cash flows back to today using our required return rate. In other words, we are asking the question, what price can I pay today if I want to achieve my desired returns over the next years? Let's have a closer look on the assumptions which we need to make in order to predict the future cash flow. The MoatIQ platform works with 10-year forecast period, which is divided into 5-year stages. For the company like the ServiceNow, the most important metrics are revenue, free cash flow, and the terminal multiple. The revenue growth tells us how fast the business may grow. The free cash flow margin tells us how much of that revenue can eventually turn into the cash flow for shareholders. And the terminal multiple represents the valuation we believe the company could trade at the end of the 10-year period. In this case, I'm using price to free cash flow as the terminal multiple. As you can see, the MoatIQ provides 3 different scenarios for the valuation assumptions. The base case scenario represents how we believe the company is likely to grow under current business and market conditions. The optimistic scenario estimates the future free cash flow under more favorable economic conditions, stronger execution, and accelerated company growth. Finally, the conservative scenario estimates the future free cash flow under more difficult conditions such as slower growth, margin pressure, or recessionary environment. If a company trades close to the conservative valuation, it may provide investors with a reasonable margin of safety. The expected return rate or discount rate is always set to 10%. This allows us to compare in between different scenarios fairly and also in between stocks. Let's now compare the current stock price to our valuation scenarios. The company is now traded at $100. This corresponds to the conservative scenario valuation. That means even if the company is growing at the assumptions which are very conservative, it should imply returns around 10% on average to the investors. If we look to the fair valuation to the base case, which is around $213, this would imply a return rate around 18.4% on average for the next 10 years. And the optimistic scenario where the company will accelerate its growth, it would imply 24% per year for the next 10 years. MoatIQ valuation assumptions are based on the historical data and management guidance. You can calculate your fair value based on your assumptions using a MoatIQ calculator, which allows you to set the revenue growth for different phases, the free cash flow margins, and the terminal multiple, or adjust to expected return. You can use the net income method or free cash flow method. ServiceNow is one of the stock which I bought recently because it's being traded around the conservative valuation. This gives me a good margin of safety for my assumptions. One of the reasons why I would sell this stock is when the price would be approaching the optimistic valuation. Then I don't think there is much of the upside potential with respect to the risk. Let's now switch to the other type of company, which would be Berkshire Hathaway. For Berkshire Hathaway, I prefer using a sum of parts valuation instead of traditional DCF model. The reason is that the Berkshire is not a simple operating business. It is a collection of many different businesses, including insurance, railroads, energy, manufacturing services, and a huge portfolio of cash and public equities. If we only use the TCF model, we could easily underestimate the value of the Berkshire Hathaway's cash and investment portfolio. A sum of the parts approach allows us to value the operating businesses separately and then add the value of cash, equities, and other investments together. If we compare the results for each scenario, we can see that the values of the scenarios are much closer to each other with respect to the ServiceNow. There are two reasons for it. First, the Berkshire Hathaway business is much more predictable than fastly growing business of ServiceNow. The second is that we think that this company will do well at every scenario or environment. So even if there is a recession, they can use their big pile of cash to buy cheap stocks and give investors a good returns. If there is no recession and economics will grow well, the returns would be also well. In any case, the stock is now undervalued in my opinion, and I bought more because I think it's also a good hedge into the recession environment. Let's now have a look to the stock which I sold based on the valuation. It's Intel. Intel stock price skyrocketed because the CPU demands by the data centers. Intel is currently traded at 120, whereas our optimistic valuation is at 53. When we look to our assumptions, the revenue growth rate for the optimistic scenario is around 10%. That means that with current valuation, it must be double to get a reasonable return. When I look to the historical revenue, which is almost zero, I don't think there is a good risk-reward ratio for the Intel, and that's why I sold the stock. To sum it up, I showed you a few examples of how I use valuation to make buy or sell decisions. My strategy is simple. Buy a stock below fair value, ideally with a reasonable margin of safety. And when the valuation starts approaching the optimistic scenario, you can consider to sell it. The valuation should never be used alone. It should be always combined with the business quality. That means moat strength and the overall investment thesis. Personally, I use MoatIQ for these decisions. It is a platform I originally built for myself, but it is now available for free to anyone who wants to use it. I hope this video will help you with the further investment decisions. Thank you for watching and see you next time.